The information provided in this podcast is for educational and informational purposes only and should not be construed as investment advice. We are not financial advisors, and nothing discussed on this podcast should be considered a recommendation to buy, sell, or hold any security. All opinions expressed are those of the hosts and guests and are subject to change without notice. Listeners should do their own research and consult with a qualified financial advisor before making any investment decisions. Investing involves risk, including the potential loss of principal. Past performance is not indicative of future results.
All right. Hello, everybody. Welcome to the Value Seville podcast. I'm here, your host, Jeff Hendrickson, with my co-host, Donnie Sitar and Bogumil. Man, I am so glad to see you. You know, I was on your podcast, it was about 3 years ago. And to now have you come on ours, man, we're completing the circle. I love it. So Bogumil, Baranowski, investor, author, caster, life philosopher. And you know what else we have in common? And you'll remember this. We're both Swiss train authority renegades. Both Bogumil and myself have a very interesting relationship with the Swiss train authorities we can talk about later. So we are partners in, I won't say crime, but we know how to handle ourselves with the Swiss train authorities. But Bogumil, welcome, my friend. How you been?
I'm doing very well. I'm very excited to be with you guys today. We had a fantastic conversation on Talking Billions a few years back, and I was really looking forward to sitting down with the two of you and chatting some more.
Great. Well, look, I know, I've done my best to read. You are a very prolific writer. You're a very prolific podcaster. There's a lot of content that you put out there, which I think is awesome. So we've got, I know, quite a few different topics, but I thought something I've been thinking about lately, and it kind of relates to AI. And we've been, on this podcast, and I know I was at University of Virginia's Darden School, had their annual investing conference yesterday. I was a judge, and kind of the theme there was AI and the way that it's affecting, one of the themes was AI, the way that it's affecting not only companies, but the investment landscape. So kind of start out, now that I've gotten into the podcast space, and Donnie and I have gotten into the podcast space, we, I think are very aware of just how much content is out there. Like if I get up in the morning, I've got a million different articles that I can read. I've got a million different podcasts that I can watch. I've got, like AlphaSense, Tegas transcripts, you name it. There's so much content. It's like this flood of information. And it strikes me that one of the skills that might be even more important today is to determine signal from noise, because we're getting so much information. It's one thing that I've been really trying to think a lot about. And so AI strikes me as a way to help facilitate that process, right? Because if you use AI, it's supposed to go through all this information and pick out the stuff that's most relevant. But I'll tell you what happened to me yesterday, Bogumil. One of the companies that was being presented, because we got all the presentations beforehand, was a company, I'm not going to name the company because I don't want the group to know who I'm talking about, but I had done some research on the company a number of years ago. And so I got on my AlphaSense subscription and I typed up a deep research thing. I'm like, I want to know everything about this company, the themes, et cetera, kind of an initiation report. I haven't looked at it in 2 years. And AlphaSense, pulls all this information. It lays everything out. I read the report. And I did this before I read the presentation or heard the presentation. I then go and listen to the presentation, and it was all the same themes that I had read in AlphaSense, right? And it started making me think, I don't know if they had used AlphaSense or what stuff they had used, but what they presented, their signal versus noise view of the company was the same thing that I had gotten. And it made me start to wonder, is this creating a problem for market efficiency? If we have this flood of information and we're all trying to get signal versus noise and we're all using AI to do it, is there a risk that we all start keying on the same narratives? Which we had a podcast with Paul Johnson where we talked about how this could possibly create serially correlated errors in markets. And so there's this one view that AI is going to make us all more efficient, markets more efficient, but I've kind of been going down this path that maybe it's going to make it even more inefficient because we're all using the same filtering mechanism to try to make sense of this deluge of information. So that's our starting point, Bogumil. What say you, my friend?
We're starting off light today, Bogumil.
I was going to say, let's kick it off with an easy one. Well, I love the question. I wrote down 7 things I want to bring up because I think it's such a loaded question, and I think it's at the heart of a lot of people's thinking mind, and I think maybe even questioning what investing is. And I see responses from people all around how people are on one hand very excited about it, the other half is really doubting active investing or maybe, value investing as such. And we'll talk more about it. But as a backdrop, just for the benefit of the audience and the context of where I'm coming from, I manage money for families and I've been doing it for 20 years. And it's long-term patient capital. And it's a certain mindset that found me, or I found it. I'm sure we'll talk more about it, but I realize how important it is to have the clients that are on the same page with you. I like to buy quality businesses, hold them all over a long period of time. And I have some positions that I've held for, 10, 15 years. So I just wait. And when I look at my process, coming back to AI, I would say that 17 out of the 20 years of me doing this, the change was very marginal, incremental, almost possible to ignore in my mind. And I was always the one that would look for the new software. And I just started 20 years ago at a new firm. And I was the one that brought new apps, new software that we could use, had people come over and show us what is it that they do. And there was a huge resistance. I was 24 and there were folks working in investing. People work until they pass away, basically. There's no retirement age. So we had 80-year-olds, 90-year-olds, and they were not as open-minded. So I had somebody come up to my desk, absolutely furious about us switching any software and telling me, what is it that I think I can do with this that he could do when he was my age with a pencil and a legal pad? And I said, nothing, but I can do it in a fraction of the time that it used to take you. Anyway, so that was the big thing that was happening at the time in terms of modeling spreadsheets and access to numbers. I think AI, and much more than AI, I think there's automation and other things happening at the same time. There's so many new companies that popped up in the last 3-4 years that are tiny, but they're offering something really targeted that I think can really save time and improve the investment process. But at the same time, there's a challenge that you bring up, which is that if we all put the data and inputs into one box and it comes out as the same answer to all of us, we're missing something. And I think we can all agree that investing is about the big picture, but it's also about subtle things. I've been in meetings with managements where we sit for an hour and I feel like 95% I'm hearing again the same thing I could see and hear and read in the annual report, and I know it. But then there's the 5% where there's a turn of phrase, there's a certain twist where I feel like, I think the margin bottomed here. Like that this is the worst it's gonna be. And I feel like we're looking up from now. Am I the only one that noticed it? From all the talking for 60 minutes, there's this subtle change and I'm paying attention to something. And I've been in meetings where you have a couple of people leave the meeting. They're all very capable. And at many points, they had a lot more experience than I did at that same time. I had 5 years of experience. They might have had 25 years of experience. We walk out and one guy says, I'm selling. The other guy says, I'm buying more. And the third one says, I've never owned it. I have to own it. Like a complete spectrum of outcomes. And we're all using our available brain power. We just heard the same story, but we all process it for our own experience, biases, preferences. Some of them these guys might be trading a lot. Some of them have 5 positions. Some of them have 50 positions. We're all different. So I think just because the outcome, the product is the same, it doesn't necessarily mean we're going to do the same thing. I want to point out something I've been thinking about a lot and maybe will become an essay. It's this idea that AI or those tools in general allow me to zoom out to zoom in. And let me explain what it means. Like I have a question about something specific that requires me to look up, 10 years worth of annual reports and a couple of quarterly reports just to find what is it that they've been saying about this one aspect, right? So it's kind of a zoom out. But then I zoom in and I can go in and find the transcript and listen to the actual earnings call, and hear them say something. And we're humans, we think we can exaggerate with words, but you can tell how they said it. And it's very important to me. So what AI does for me, one of many things, is that it allows me to find exactly what I should be looking and then go in and pull up the actual filing or the actual transcript, or sometimes just hear the voice of somebody say, it was a decent quarter, but in their voice, I can tell. I think it was worse than you guys are making me believe, like whatever I read, it's not the full picture. I'll stop here, but that's my initial thought.
Yeah.
Donnie, do you want to, I can go, or it's up to you.
Yeah, no, I think, and there's a lot of, angles to go down on what you mentioned as well, but maybe just start with, I think there is maybe the big narrative out there that's been recently is that, hey, it's the value investing is dead kind of thing that's been floating about, and AI is one of those that's kind of off on it. But, when I'm kind of hearing the way you think about it is it's actually reinforcing, because the behaviors that Bogumil looks for I can get to them even quicker with AI. Like I can get to the intonation of the manager quicker. And I don't know if that's as democratized, because it's kind of hitting your independent nerves. So it's just,
Yeah.
I guess maybe broadly, is it, when you talk to your clients, like, and I mean, they're coming to you. I mean, is there this vibe that maybe this is all for naught in some sense, that it's going to be democratized away? Or maybe that's starting first. And then I think second is, I mean, do you really feel that way? It sounds like you really don't. I mean, it sounds like you're kind of on this other, that it's giving you a reinforcement into giving Bogumil the superpower that maybe you didn't have before. And that's how investors should be maybe looking at it.
The superpower. The way I look at it is, I think sometimes we lose sight of what we're trying to do. Like in terms of, for example, my clients, they have a certain capital they don't immediately need. They can't afford to lose it and has to be deployed, right? And I found that for the clients I work with, holding a portfolio of stocks of a certain quality over a long period of time serves their purposes. They feel much more comfortable knowing exactly what's in the portfolio. We can walk through the financials. I can explain the businesses. Than holding, an anonymous group of, 500 or 2,000 stocks. It's just, there's no commitment or conviction behind that, at least from their perspective. It might work for somebody else, but it doesn't for them. So for me, it's a question of what will give me the courage and conviction to hold those 30 stocks, not on an average day, but during a really tough time. And I took some really heartbreaking calls in March of 2020 from fellow investors and colleagues in the business. A lot of clients called me. Some told me that they just wanted to hear my voice in March of 2020. The market gave back 3 years of gains in 3 weeks. I mean, just to think about it, you guys remember, it was just
so exciting. I loved March of 2020. That was the heyday.
Stocks were.
It was not a good time for people, but the virus and all that. But from an investor perspective, my God, there were some cheap opportunities in March and early April of 2020. I mean, sorry, I don't mean to cut you off, Bogumil, but guys like you and me and Donnie, like we were, I think, licking our chops in that environment.
Yeah. Once you got over your own emotional reaction to it, and other people's reaction to it, and there were a lot of things to look at and buy. Stocks were coming to me instead of me chasing them. And I love those periods. And in my mind, I thought that this is going to last a lot longer, but that's a whole different point. The point that I'm making is, you're holding those stocks 10, 20, 30, 50, whatever it is. What does it take for you to keep on holding them or add to them in a period like this? And what gives me comfort, confidence, courage, however you want to call it, is that I know the businesses that I'm holding. And I see just AI as a tool that a lot of people use in all kinds of ways. Some people maybe will use it to trade daily, although I don't think it's really helpful for that. Some people will use it to build conviction and courage to hold things over a long period of time. I've met enough people, not just interviewing the 200 over the last 3 years on the podcast, but in general, that told me, in all honesty, that they bought the right stocks at the right time, even at the right price. But they failed to hold them long enough. And I think this is this untold truth about investing, that it's incredibly difficult to hold some things over a long period of time. Chris Mayer wrote the book 100 Beggars, and he openly says that the dead money periods are tougher than the drawdowns. And a lot of stocks in my portfolio, they were dead money for 2 years. And I had clients ask me, why is it still in the portfolio? And I'm sure you might have experienced something like that. And it's a fair question, because I ask myself, why is it still in the portfolio? It's not pulling its weight. So I think whatever gives you courage to hold it, I think that helps, at least the way I see investing. So AI is a tool I think can help. I think it can maybe allow us to focus on what really matters. Back to your earlier point, there's no doubt that there will be more information, more data, more output, more people writing and sharing things. So how do we sift through all of it and focus on a handful of things? There's a million podcasts out there, but I listen to a handful. And even the podcast that I listen to a handful of episodes. I think at the end of the day, and maybe there's a theme there with actually hearing human voice, there's something powerful about having somebody that you've respected over many years, and you read their books, and maybe you overheard them at a conference, and have this 60-minute window with them and listen to them almost one-on-one in a podcast format. That beats any fireside chat on stage at a huge event. You really have a very intimate look into, how does Peter Lynch really think? I listened to his interview recently, and his book, One Up on Wall Street, is the very reason why the three of us are talking here today, at least for me.
Books I read. I read that one before I read Intelligent Investor.
but actually hear his voice and how he's talking about stocks he's looking at today, I feel like I know him. I don't know everything about him, but I know him, that kind of feeling. And I think that's why we love podcasts. And as a medium, I think it has a special place in a lot of people's hearts. And you can't really replicate that in many places the way a podcast can offer us that window. I'm hoping that earnings calls are that kind of a window. And I think it could be that kind of a window. And there are managements that are very frank and open. And I've seen them say, this is a bad quarter. These are the 3 things we did wrong. I would rather hear that and anybody telling me this was a great quarter, and I'm looking at the numbers and I say, I just don't know what you guys are talking about. This was really bad. Why don't you just tell us it was really bad? But what are you going to do about it? That's what I would really appreciate.
One of the things in your article on AI is you said that you thought that AI would make it harder in some ways for people to hold stocks for longer because all these, the constant deluge of information, of narrative shift. Why do you think, because you could argue the opposite too, that the more you know about a business, the more conviction you have, but you kind of came at it from, I think you said the time horizon arbitrage. If if you have patient capital, if you have advantaged capital where you can take a longer term view, that's becoming a stronger edge because you thought AI would make people more willing to turn over positions before they should. Maybe elaborate there a bit.
So I think Ben Graham had this quote, which I should look up and memorize for the benefit of those conversations. But he basically said 100-some years ago that technology changes, how we trade changes, how we research changes. And it was a whole different level of technology than we have today. But it's the human behind it all that moves the markets, and that won't change. Human emotion, fear, greed, and we have a response to it. We panic, we get excited. It's just human nature, so that won't change. And what won't change is that it takes time for even the greatest business to make a huge difference. It takes time. It takes time to launch a new product. It takes time to enter a new market. It takes time to establish a meaningful market share in that market. It takes time. So that's not changing. Maybe we are doing more things quicker, but that's not really changing. So if you're looking for a meaningful upside in any stock you're looking at, you're going to have to wait. And AI is not going to change that. I think AI is a tool that can both empower and get us in trouble as well. And I brought up in that article and in some conversation as well how I came across investors that love the idea of turning every stone. And I think it's just an excuse not to act on an idea. If I'm 100% blunt about it, I think it's just that moment where I don't think, and I asked some friends that have that moment with some ideas at some point. I asked them and I said, I don't think you just want to own it. And if you don't want to own it, don't own it. But I think this idea that you're going to turn enough stones, that finally the 100th question that you're asking is going to give you the conviction. I think it's not going to happen. If you're not, let me reverse. So I have this idea that you could have a one-page, very simple investment case for most of the stocks. And there's a huge benefit in it because if it takes a paragraph or a page, whatever you need, to convince yourself that it's a good idea, you go back and you look at the 5 metrics, 3 metrics, you check if they're still okay, and you're going to keep on holding. That's my conviction. If you need a 100-page report to explain to anybody why this is an interesting idea, I know it's very alluring, because it's an intellectual puzzle and, it's so complicated and how the pension funds are funded and how this is done. And then they have those very complex liabilities and they have this arrangement and this confusing licensing deal. It's like, that's amazing. And I think it's so alluring for us because we love the puzzle. But if it takes 100 pages, I don't want to have it in my.
And it's a lot easier to get to 100 pages now than it ever was, right?
Oh, yeah.
And that's and I've seen that with just even myself. Sometimes I'm like, I got 100 pages of noise here. What am I doing? I want to throw a little bit of a right turn here. So I have this concept of 1% IRRs, and the idea is just, can you find a tool, habit, technique that you can kind of implement, immediately in a sense, and just get a little bit better. So here's my my 1% IRR question. But what tools are you using today with AI in your own practice? What AI tools are you using? What are you leaning on that maybe we can all jump on the bandwagon with?
Well, without endorsing anybody, I use the obvious ones that a lot of people use as a check. So I'm not going to endorse anybody. I do use some paid ones that one of them happens to be a sponsor of Talking Billions. So I'll save it for that. But I'll say that I think you have to find tools that work for you, and you have to understand how those tools work, and you have to understand the limitations of those tools. And I think I would make a huge distinction between tools that are kind of facing the universe and pulling from, transcripts and earnings and reports and everything else, and the ones that are kind of facing on the inside. And I think the second part is not really discussed enough, and maybe it should be, where I have so many notes that I wrote up that I took for my own benefit at different points in time. And I have a pretty good note-taking system for my own benefit with, tickers and dates and positive, negative, and it's all organized. Now, the current AI that I use allows me to go through my own notes and ask questions, because
I think I know what AI you're using, but yes.
But to me, I want to be very humble about it. But the truth is that my memory cannot hold all the data points all equally, right? Obviously, the stuff I read yesterday, I can probably tell you in much more detail than the stuff I wrote 5 years ago about a stock, right? But with that tool, I can skim through a lot of notes, and some of them, honestly, I don't remember writing because there's so much note-taking happening. I don't remember writing it. Like, it's almost like you're reading your own words and you realize I have no recollection of writing it. Right. And it's kind of like a note to your future self when you took the note, or the note you're taking today. I think that inward-looking AI can really tap into your own resources that are just sitting there on your drive or in your note-taking app. And I wasn't using them. And I found things through that tool that allowed me to see things that I might have missed and then explore a whole different thread that gave me a bit more conviction. When you really think about it, the investment cases in the big picture that have worked and that they made the most money out there for the biggest number of people, they're very, very obvious, right? So it's not like we're all looking, at least I'm not looking for something that's so obscure and so unheard of and so unusual. At the end of the day, I'm looking things that are sometimes staring in your face, but it still takes a lot of conviction and courage to buy them. I'm sure we're going to talk about it more, but you said, value investing is dead. And I have a reaction to that, and I want to explain why.
Yeah, go ahead. Love to hear it.
So to me, the concept of value has been with us for as long as we've been walking on this planet. I talked to somebody about the hunter-gatherer community from, tens of thousands of years ago. They had to make a value calculation every single day. It will take that many calories to get that many calories back in food. They were setting up traps. They were following bigger animals to pick up food that animal didn't finish, and all kinds of things so they could save their calories. We're so conscious about the use. It was a life or death calculation in terms of how much value you're going to get and how much value you're going to put in. Now, I used to walk around a farmer's market with my grandma, and she knew exactly the concept of value and price. She's no value investor, but she understood that this is a good price for that kind of value she's getting. She wasn't looking for the cheapest carrot available at that market. She was looking for the one that looked really, really good, but somehow whoever was selling it priced it really well, and she was willing to maybe even negotiate and buy it. So the concept of value is going to stay with us forever. It's not going anywhere, and it applies to your time, to your money, to your efforts, to anything else. So we bring it to investing, and I think we get confused because some people understand value investing as only a low PE investing or a low price to book or low this or that. We're all, as long as I ask you, why did you buy that stock? And you tell me, I paid this much, but I think it's worth much more. You are a value investor. How you arrived at that, that's secondary. That's your own framework that you are comfortable with, and more power to you. But as long as you do that, you are a value investor. If you come to me and you tell me, I bought this stock because the price went up 20%, I think it will continue going up, you're not a value investor. You're something else. You're a momentum investor, price-driven investor. You might not even care what this business does, but you're buying stocks that went up yesterday or went up in the last 12 months. There are people like that, and it's okay. I think the market works because
momentum works. That's well documented. It works. Arguably, academics have said momentum works better than value. Buying positive price momentum outperforms buying cheap over long periods, especially. So
until it doesn't.
Yeah. Well, but I could argue that about anything, right?
Yes.
We all have limited data sets on the way financial markets work.
It sounds like what Bogumil's saying is that the cheap isn't
not work in the future.
Yeah, is that cheap isn't the question here. It's something different, and that's the
Bogumil,
value investment.
Let me drill it there, which I've seen value invest. Whereas, because undoubtedly, but historically, the way a lot of value not always, but largely is crap.
Yes.
Now they're saying, well, okay, some are moving and saying, well, I'm buying growth because that component of value matters more than it used to, but I'm still buying something for less than I think it is. But I go to value conferences, and I'm sure you go to them too, where I meet a lot of investors who refuse to even look at the top 20 companies in the S&P because they don't want to pay 30 times or more, because they're living by these old dogmatic views that never pay more than 25 times or something like that, which is kind of this older version of value investing. And so while I totally agree with what you said, I meet a lot of investors who still are taking a playbook that worked in the 90s, early 2000s, prior to the financial crisis, and they're applying it today, and they're frustrated that they're underperforming. And here's the other thing. And they also, well, when you mention, well, maybe you should be paying up for quality, they give you this very condescending kind of look as if you're the idiot because you're being swept up in the narrative. And I look at these folks, I'm like, actually, no, you're the dogmatic idiot that won't evolve. And it's ironic to me that some of these value investors think they're smarter than everybody.
Yes.
And yet they don't see value in paying 30 times. And I brought this up on the podcast with Paul Johnson, but there's a guy, he runs Fundamental Edge, his name's Brett Cochran, and he did this analysis on Google where he went back and created a DCF like in 2004 or something. He said, if you actually knew with 100% accuracy what the free cash flows that Google was actually going to produce over the next 25 years, what PE multiple should you have been willing to pay in 2004? Yeah. And the number was insane. It was like over 400 times. And so like this idea that we should be focusing on low PE, I think still is fairly popular in a lot of the circles that you and I run in. And I just don't know how long investors are going to have to underperform before they start thinking about it differently. And this kind of gets to the article that you wrote. Going from cheap to higher quality is a progression we all as value investors make. And buying the cheap 5 times PE stock, that was fun back in the day, and it has its moment and still might where it works. But what do you think about people's ability to move on and see value through the lens that you're describing versus the lens that I described? Like, are there people that are just never going to move on and kind of stick with these, Donnie, I think you called them once, limiting?
And another easy question. So let me work my way kind of backwards a little bit. So somebody shared it the other day how the year-to-date performance, and I don't want to pinpoint anything, but somebody said how, a certain category is having a difficult year. And many people actually mention it in some contexts. And I said, what do you mean by that? And they said, this approach underperformed by 5 points, whatever it is. But then I say, if you forget the index for a second, and when you talk about something working, for me as an investor, something working, it means it delivers a respectable return over a long run without risking the permanent loss of capital. That's how I look at it, right? So if you told me that I can never look at the S&P 500, let's go a step further and say S&P, whoever is the sponsor these days, they decide not to maintain it. It goes away. There's no index of any kind. Or maybe we ban them. We ban things. We ban index. No more index. It would make no difference in what I do. No difference at all. I'm trying to buy the same kind of businesses today that I'm going to buy tomorrow and hold them with the same mindset for the same benefit for the same kind of client. No difference, right? So when somebody says that something is working or not working, I want to know, is it making as much money as you're hoping to get out of the effort you're putting in and relative to your expectations? The index has really changed a lot. It's a very different index than the one I remember 20 years ago. Actually, if you take the top 10 stocks that were in the index when I started, half of them got government bailouts in the next 2-3 years because they were major banks. Intel was one of them that has a government investment in it, and there was GE among them that's going through its never-ending restructuring that some people pay more attention to than I do. So that was the top 10 stocks, right? I think there are many reasons not to hold them. I know investors that don't own banks at all. So anyways, at the end of the day, if you find an approach that works, I'm thinking of Walter Schloss, for example, 100 years of investing, a living at least, and new Ben Graham. I don't think he really changed much as I know from reading. So it worked for him. It did what it was supposed to do for him, and he kept doing. And I don't think there's anything wrong about it. When I started, I had the benefit of working with people that had mentors that remembered the Great Depression. So they were towards the end of their career, and they were telling me stories that they heard when they're my age about the Great Depression. The Great Depression was an awful period. And I don't think any of us, I definitely cannot imagine what it was like, but it was a total standstill for the economy. The market went down 92% over 3 years. Massive unemployment, massive structural shifts in the economy, going from agriculture to a still underdeveloped industrial economy. Service economy was tiny. There were a lot of things. And then we were experimenting with gold and money and monetary policy, a lot of things at the same time. So Ben Graham And he's not the only one. There's so many people that walked away from the experience thinking that investing is a static experience. You buy a dollar bill for 50 cents and hopefully you can cash that and get the money back. That's the initial early Buffett's investments. He was not really hoping for the future. There was no future during the Great Depression. We all know that there was, but they thought there is no future. But then it was a massive shift happening among many investors, including Buffett himself. If you read his write-up of Geico, it ends with a sentence or a paragraph that says, "This business has a bright future. Look it up." And for me, it's such a telling moment where as a value investor, you say, I'm not just looking around to cash that dollar bill at a full value, face value. I'm thinking about that dollar bill becoming 5, maybe 10, or Chris Mayer tells us maybe $100. So it's a whole different mindset. I would call it a more dynamic way of looking. I'm not saying everybody has to think that way, but it's a way that really opens you up to a lot more opportunities where you believe that there's a future value creation in a business. And that's intuitively, it just feels aligned, at least with my way of thinking. You know, if I start a business, I'd like that business to grow. If I'm buying a small piece of business, like Peter Lynch told us, stocks are small pieces of businesses, I'd like to own a business that's not just worth more dead than alive. I'd like to buy a business that can get bigger and better. And I met people who since then, you know, passed away, but they were waiting for the PE of the market to go under 10 times. They told me, Bogumil, just wait. And the sweetest human beings, they taught me a lot. They showed me a lot of things. But we never got to that 10 times P. And I certainly hope none of us here has to live through the S&P 500 at that 10 times P. That would be brutal. Yeah. We never got to see it. But you have to find a way. I have to find a way. We all have to find a way to identify opportunities. I want to add something more personal here. I spent quite a bit of time early in my career believing that I will find the cheapest stocks out there. Yeah, I'm as guilty as anybody else. And in the article, I point out that when you really peel the layers here, the reason why any of us have any capital to invest at the beginning is because we are frugal by nature. We understand some element of frugality. We absorbed it, whether it was your grandma or grandpa or your parents. That's what I've seen among a lot of investors that stayed in the business over a long period of time. I think the challenge is that we don't appreciate that at some point, buying the cheapest car from the parking lot is not the best idea. It won't get you as far as a car that maybe it's a bit more, but it's not in as poor of a shape. And in that article, I say, you don't go to the cheapest dentist. And it's such an obvious statement when I frame it that way. And it really resonated with people because I'm sure you guys, or I have visited dentists, and I always realize that I want to pay enough so I don't have to see you again. I mean, it's a peculiar service when you think about a dentist, right? Super intimate, a lot of trust. But at the end of the day, as much as I like you, I'd rather not have to see you for a while. And definitely not to address the same issue, right? So we're not looking for the cheapest dentist. I'll mention real quick, there was a stock that I was spending a lot of time on years ago in the first half of my career. And I had a senior portfolio manager walk up to me. This company had issues, product launches, management change, too much leverage, but it was just so cheap. And the margins were kind of holding at a certain level, not getting any worse, but it was just not going anywhere, just stuck. And he came up to me after one of the meetings with the management that came into our offices back in the day. And he says, they have a competitor. And I said, I know, but the competitor trades at a higher multiple. And he says, but they get everything right. The product, the distribution, the launch, the branding, the pricing. Just look, they're winning business left and right, and they don't have as much leverage. And he did a fraction of the research that I did, trying to understand this really challenged business that was just so cheap. And he did a lot better because the stock was just such a pain to hold. And I had to watch it so carefully because it was just getting worse and worse. And eventually we ditched it with a small loss. But back to a point that I'm sure will come up, when you look at the portfolio, it's not just the share that those stocks have, 2%, 5%, 10%, whatever, but the share of mind that a stock takes up. If you have a 1% position that takes up 50% of your attention, and I mentioned it before in an article somewhere, just sell it. Do yourself a favor. If it's a 1% position, even if you're absolutely right about it, it's not going to move the needle. And you're going to use the 50% of your attention watching the other positions you have or looking at something much more interesting. Again, I think it's a challenge with investing because it's an intellectual puzzle and it's so alluring to deploy your brain power trying to figure out something that's not possible, or it will take so much. It's the hurdles, the 1 foot hurdle that Buffett talks about. If it's too complicated, just move on. I
Yeah.
think it's the hardest thing to do.
I like how these are the tough questions of investing, and they can't generically be answered by an AI. I think, to your point, the
No,
looking inward element is where to go. You touched on something, and I kind of want to double click on this if it's okay, and we can go as deep as you want here. But you mentioned the Great Depression, but I thought I read it, and maybe this is probably overstating it, but you mentioned, I think you grew up in Poland, if I'm not mistaken,
yeah,
and then there was a time where there was actually no capitalism allowed, and
it's
conditions
correct.
really and so, like, it may not have been Great Depression. Maybe I don't know how you would describe it, Great Depression versus not. I'm kind of a
Yeah,
Americans tend to be very centered on America, which, I
yeah,
have a question about that as well. But maybe just talk about, like, because you have a lot of, I think, references to your grandmother, and the frugality elements. Like, how were they influenced to where you are today? Because I think you're a prolific learner, a very thoughtful investor, and certainly understand the value equation. I think on a lot of different dimensions. But I think it would be helpful to round it out a little bit. If you're okay touching on that
that's
subject, but you can go a different direction if you want.
yeah. No, I bring it up now and then because I ask my guests on the podcast, tell me about your childhood and upbringing, and you'd be surprised how many people have not been asked about it, because we just jump in. I graduated from this school, this was my first job, and on and on. But the seeds were planted for you to do what you do a lot earlier than we think. And it's the same case with me. I was born in Poland in 1980, so I got to see the last decade of communism. It was an economic and political experiment where there was no private ownership of business or most assets. There was no stock market. Since the Nazi tanks came in 1939, the stock market didn't open until the 1990s when I was a teenager. So there was no stocks, and the
Wow.
banks were owned by the government, and the government was the only employer and the only supplier of everything. There was the ultimate utopia, and there was Poland.
Command and control.
And there was an office building in Warsaw, in the capital, where people would have jobs, and their role was to set the prices of goods, from a nail to your coffin, all the way to shoes and TVs. And they had no idea of the actual, not just price discovery, but the cost side of things. When the economy was opened up in 1990 and the Berlin Wall fell and free elections and the free market economy was reinstated and you could own things all over again, and businesses were started, the economy had to rediscover itself. Like, how much does it really cost to make a pair of shoes?
How long did that take, by the way? How quick is that process? I'm curious.
There are books about it, and I actually met the prime minister, finance minister at the time, who was responsible or credited with what they called the shock therapy. And there were actually U.S. advisors from Colombia that came to Poland and to that bloc, that part of Europe, and advised how to go about it. How do you switch? There's a huge difference between being an emerging market where you're gradually getting bigger and better and going from a frozen state of economy with a huge potential. People were getting degrees and getting educated. They had talent, but they couldn't actually sell it because they had to be hired by the government. The government had an income schedule, and you were paid based on whatever some official decided. So my parents were 2 doctors, physicians, and they were paid less than the electrician that lived in our apartment building. So the electrician could work on the side and help people fix things in their homes, which was kind of a gray area. My parents couldn't work on the side because they had to be practicing physicians within the government-owned hospital system. So my dad was walking to work to take his night shift overnight at the hospital, and the electrician had 2 cars. They were crappy Soviet-era cars, so nothing to be really, too envious about. But the point was, it was very confusing for a kid. Should I become an electrician, or should I go to college and get a degree? You can tell that it was a bit confusing. You would go get a degree just because you were curious, not definitely to improve your financial standing. Very confusing for a kid, but it changed quickly enough, so I realized it pays to go get an education rather than to game the system from that perspective. But it gave me an understanding and appreciation for the free market economy, how that works and how it benefits everybody. And Poland made a huge leap in the last 35 years. And I think in terms of purchasing power, it's catching up with Japan. In the 80s, Japan was like the power in the world, buying up US assets, and Tokyo, whatever, was the real estate was worth more than all of New York, I don't remember, but it was, Japan was at the top. So to think that Poland, at least in purchasing power terms, is catching up with Japan in my lifetime.
Right. It's a pretty remarkable thought, right?
Right. So if anybody argues with me and says, free market economy doesn't work, capitalism doesn't work, and private property doesn't work, I mean, I have no words.
That view is becoming popular in certain, political echelons of this country. I think.
Yeah, that's fascinating. Thank you for sharing that. That's great. The backdrop's amazing. I think one question I would, kind of dive on there too is that you mentioned this accelerating growth in Poland. I think sometimes I think of like American investors. It's almost like we're at the REI garage sale. Everything's already been picked over, and we're looking at the same things and trying to say, well, actually, no, maybe this is worth more. But when you go abroad, like you mentioned Poland. Or, there's other, and maybe Poland is more advanced now, and I'm kind of simplifying it, but 20 years ago it might not have been. But there's other places in maybe Southeast Asia or just other just developing economies that are picking up stuff. And there's maybe these great opportunities where you don't have quite the same brain power looking at the same 3,000 stocks only and trying to make hay of it. So I don't know if you have you explore like Poland or other places around the world, or are you still U.S. centric today? You certainly quote the U.S. guys quite a bit. I haven't heard a lot of Polish philosophers yet, so maybe we'll get some of those here at some point. But yeah, maybe just understanding, your thinking there.
Well, there's a book that all the kids read in Poland, and it's a family saga from 200 years ago, and there's one expression there that really stayed with me, and I brought it up in one of the articles, which says that it's a horse that has an owner that does better. Basically, that the owner's eye makes the horse fat. And that saying was borrowed by that author 200 years ago from a Roman saying. So it's 2,000 years old. And that Roman saying was borrowed from a Persian story from way back. And it's the idea at the core of what we talked about, which is private property is this invisible force. But we know as kids that you take care of your own toys better than a toy that was just given in the kindergarten for all of us to play. We've seen it. So I think it's at the essence of, success of anything. And there are books written about it, how countries that start to respect property rights just move to a whole different level of economic development. People that know that they own this piece of land that they're farming, they treat it in a different way. They can take out a tiny mortgage to buy a little bit better equipment, to farm it better, and on and on and on. You have this avalanche of consequences that help the economy. Now, in terms of global opportunities, it's a layered and complicated question to me. I think there are people that are much more gifted and closer to a lot of markets that have an advantage, and I've had quite a few people on the show who are focused on one aspect of the Asian markets or one part of the world, and they're really good at it. They're very close to that market, and I think they have an advantage that I personally cannot have sitting in the US, and I know that. And I visited South America, and I visited companies around the globe, and I feel like me going somewhere every 2 or 3 years will never match somebody that grew up with the families that are running some of those businesses. And I think that's a huge advantage. So if you find a pocket that works for you, and I have friends that are invested only in one market that you and I would call emerging market, and they have a handful of businesses, but they know the names and the stories of people who are running these businesses, I think they're in a good position to know exactly what kind of assets they have and what to expect. I don't have that advantage. Yeah.
Do you know Masoud from ValueX? He only invests in Turkey. He's from Turkey.
Yes.
He comes to mind when you mention that. I mean, he knows more about Turkish businesses. He's the nicest guy in the world, and he is passionate about it. And when you hear him, he's pitched these Turkish companies at ValueX, and they're amazing pitches. And I remember thinking the same thing that you thought. I'm like, I'll never in my lifetime know more about these businesses than Masoud does, because he knows the culture and all this. And so I totally hear what you're saying. I think you have to know when you're beat, right?
But I want to emphasize that as a US-based, US-centric investor, we have a window to that world. And I don't want to miss that in this discussion, because when you look at, and I look at my companies, in many cases, more than half of their profits come from overseas.
Right.
Most of the businesses these days, with very few exceptions that I can think of, at least in my universe, they operate in 100, 150 countries. So I have the US laws and protections and disclosures and shareholder-friendly culture and a liquid market, and you name it, probably like 20 different things that the US has to offer, and the talent and on and on and on. But at the same time, I let them, sort of like you hire a manager to do the work for you, a fund manager. Here you hire the company to deploy this capital, not just next door in the town over, but also to have a team that's based in somewhere, Vietnam. And they have that team, they hire them locally, and they know where to manufacture, how to sell, how to price. And I think US has this incredible advantage that US brands are highly desirable around the world. It's not talked about enough, but a US brand just has this immediate premium perception, whether it's a soft drink or if it's a car or whatever it is, or technology these days. We feel like it's a stamp of quality approval. And so when those brands show up in a different market, they have this incredible advantage. People just want it because they saw it on TV, they saw it in a TV show, they heard about it, it's never been available here, they want it. Now, if you turn it around and you have the most successful, for example, Thai cookie company that makes sweets, you and I have such limited chances of ever hearing about it. So that company will max out maybe in the country, maybe in its region, but to make a leap and reintroduce itself to a whole new consumer market in Switzerland or in the US, the leap is just too big. So there's this untold truth that the US, it's not only a magnet for talent and capital and knowledge and ideas, but also it's an incredible exporter of those to the world. And we benefit by even holding, the 30 US stocks that you like that have half of the business overseas. Now, if something goes wrong, and I want to emphasize that sometimes something goes wrong. I remember visiting South America almost 20 years ago. And it was that time where Venezuela was on an edge. Is it going to get really bad with Venezuela? I think we all know now how Venezuela was one of the richest countries in South America and has one of the largest, if not the largest, oil reserves in the world. And was taken over by a government whose beliefs rhyme with the beliefs of the government that was running Poland when I was a kid. Different edition of it, but still, they confiscated everything at the end of the day. And there's a shortage of gasoline at gas stations in Venezuela while the country is sitting on a massive oil reserve. That's what happens when you try those ideas and you go too far. Anyways, I was meeting people in Brazil. They were telling me that they're buying assets in Venezuela that Americans and Europeans and Canadians are selling because they're also from the same continent. They understand the risk. Apparently, they didn't understand the risk because the country went so far that they lost those assets. And I remember one specific case, Colgate had a $1 billion write-off. Somebody might correct me if I'm wrong about the exact number, but I remember it was very close to $1 billion. And Colgate had to write off their Venezuelan operations. And I thought, I see what I do as a portfolio of a portfolio, right? So I own one stock and no recommendation of any kind, but let's say Colgate. I see Colgate as a portfolio in itself, right? It has its own variety of products, but it also has a portfolio of different markets. Some of them will do well, some of them will do. Actually, Colgate, for lack of a better example right this minute, but has better market share in other markets that are not US than in the US, which sometimes happens that you have a US brand that has a better standing and better margins in foreign markets than the US. Why? Because we have so much competition in the US. It was launched and funded and everything in the US, and they go somewhere and they win so much more market share and the share of mind in new markets. Anyways, Colgate wrote it off. And I thought, it's just like a manager that tells me, I had a stock pick that didn't work. Okay, we're moving on. What else is going on? That's how I look at it. So I feel like businesses that I own do the international investing for me while I'll get everything else that the U.S. offers. And I think U.S. offers a lot.
I think that's
it reminded me of a pretty funny story when I had a past life. I was working with clients, a lot of European clients, and when they would come over, they had to get Levi's jeans. We'd literally go to like outlet malls, and they were like, the price of Levi's jeans are so cheap here, and stuff in the suitcases with Levi's. And I haven't bought a pair of Levi's jeans in decades. It's just something that I wouldn't think of, but they liked it. They said
501.
It says they're strong. It's American strong, and they like that. So I thought it was kind of funny. That's interesting. Well, another just whole different topic. Unless there's anything, Jeff, on that one, I wanted to go down with you is. This last 2-year odyssey. It sounds like a 2-year odyssey you've been on. I mean, you can fact check me on that, but you've
podcast 3 years. 3 years. It's
3
actually
years
exactly
of podcasting, and just
it's wild.
All of the conversations you've had. How much they've either been something you've picked up from someone else or helped you, I think, refine a thought on your own. But Jeff and I are just starting this podcasting journey, so it's a little bit of a selfish question. It might not be broadly applicable to everybody, but I think we certainly Jeff and I will talk for hours just about this game, and I will have a kind of a cohort of investors that I just talk to, and in some sense this is just like the open book way of talking out loud. But I'd love to hear your thoughts and the the learning trajectory that you've been on and how it's maybe unintended consequences, things that stuck out with you over the last couple of years.
It's an incredible window to the world to me. It has become this incredible way of being able to sit down and talk with people that are in my life or that are joining my life through the friends that I have. It's an incredible ecosystem. So it's almost 200 guests, which is unbelievable to me because the intention was to record 6 episodes and here I am, going 200 strong. But I mentioned to you earlier that what you can create in that 1 hour with somebody, it's very hard to replicate. Jeff and I took trains in Switzerland and argued with the conductors and so on.
And by the way, that was not us that got in trouble. We were defending a fellow value.
We were defending. Yeah.
Whose ticket was off by a day, and they wanted him to buy a new one. And Bogumil and I explained how ridiculous that was because there was nobody else on the train anyway. We were right, and that they didn't listen to us, but whatever.
It was an eye-opening experience.
I couldn't believe how dogmatic they were about it. I was shocked.
We love the rules until they we love rules until they apply to us. I think that's the
totally.
But to me, creating this 1 hour with somebody in having this intimate conversation, it's really a window to how people think, what they're about. And the people I get to talk to, it's really not about the money at this point for them. They just love whatever they're doing, whichever aspect, expression of investing or wealth or whatever it is that they find so appealing. So to me, to get a little bit closer to that, eternal why do you keep on showing up? Why do you love it so much? And share what you've learned over the last, 20, 30 years, and having this 1 hour with somebody that the audience gets this incredible value when somebody's trying to condense it, and not in like an AI dumbed down form, but like, honestly, if I just had 1 hour with you, these are the things I would love for you to know. And if you can capture it and keep it evergreen, that's why I really like talking about things that people can pick up 10 years from now. And I feel like this conversation can make a difference. That's really important to me. And it's not just the guests and the friends of guests that reach out, but the audience has been so wonderful, writing and interacting with the content and sharing their stories, and then pulling me aside at events, conferences, on the street, at coffee shops. And it's so fun when you realize it's not the fame, because you can hardly call it fame when there's, 1,000 people that know you. I don't think it's fame, but the right people that would benefit from what you have to say, they found you in this massive universe. And I think that's the bigger picture, and I think applies to more people. If you want to learn in public, you can really benefit from it. I think it's a very vulnerable position to be in, writing down anything and then sharing it with other people, whether it's a newsletter or a Substack or a podcast. But what you get back from the people that have something positive and encouraging to say, and even if they poke holes in what you shared, I think can make a huge difference in what you're trying to do. At the opposite end of it, I'll mention how in the investment profession, a lot of firms, and I don't want to point out anybody, but the mindset is that, you have this firm of, 3 employees and or 10 employees, and then you have an investment committee of, 15 people or 20 people. And these are the only minds you can tap into. I always thought that this is such a limiting idea because we might not have at that table somebody that has been recently to Argentina and we have nobody that can tell us about what's going on. But if you expand that among the 200 people, you can have somebody that just got back from Buenos Aires, and you can get them on the phone and talk to them. Tell me what's really going on. I'm reading, but I still don't get it. Walk me through it. And it can be somebody that spent the last week visiting companies there and can give you a perspective. What's happening in Argentina? So these kinds of things, I think AI will not capture anytime soon, but these are the things that are like real life experience with real people that I think people value listening to podcasts. Not just the official statement of a CEO, but how does the CEO really, really think? What moves them beyond the stock-based compensation incentives and all that? Why do you care? Why do you show up? Why are you there at 5 a.m.? Why do you pull it on an apron and just get behind the bar and sell coffee just to see how your employees are doing? Tell me about it. And I feel like that gives me the extra, confidence, courage to hold some stocks that I might hold, or maybe open my eyes to some stocks I should be paying attention to. All of that is very subtle, very incremental, but I think that's where the real value gets created when we expand and see things through just not our own perspective, but through other people.
So, this is a conversation I've been having with people, like what is going to confer edge, in investing in the age of prior to AI, I would argue one of the things that makes really good investors really good is they're able to, as I kind of alluded to earlier, look at this chaos that's going on in the world or with a company or an industry or whatever, see disorder, and they're able to chunk it up into the big, simple questions that need to be answered. And they're able to filter it all in a way and get insights that other people can't. And I think that's still a very powerful capability, but AI makes it, if you're not as good at that, is a tool that can make you better. So I wonder if one of the edges that will matter more in the future is more of a social edge. And what I mean by that is the valuable information that you will not be able to get from a large language model comes from what you just described, Bogumil, which is meeting people, getting on the street, burning shoe leather, and creating a network, whether it's within an industry or within a country, and building deep relationships where if you have an investing question, you can reach out and get that nuanced insight that somebody who just spends their entire life trapped in their basement. I laugh as I'm sitting in my basement right now, but historically, great investors to me were the Warren Buffett never leaves his office and just reads 10Ks all day and just have the raw brain power to process stuff. Like, is that becoming less important relative to your ability to get out of the office, not read as much, and actually meet real human beings, creating the relationships that if you need to pull down on that wisdom at some point in the future, you can do it, and you can do it because they like you, they want to help you. Like, is there a social edge, almost like that exists in venture capital, that might be applied to public markets in the future, do you think?
I think 100%. I think 100%. And you and I being part of Value X, I think it gives you an idea of just having people in your life that see the world. I wrote this piece a few months ago, eyes in 1,000 places. I travel, I go and I see things, but I still can't be everywhere. So having somebody that's there, whether it's Turkey you mentioned, or I have friends in Thailand, just being able to talk to them and just tell me what's going on. It's not that they will tell me something, that they will give me their own perspective on something. And that's very valuable and maybe will give me the additional, courage, conviction when I really need it. So I think that's something that will outlast any technology. AI on one hand, I think can help, but at the end of the day, we want to see real humans. You brought up Buffett, and I want to bring up a couple of stories that came to my mind. Recently, Brett Gardner wrote an incredible book about the early investments of Warren Buffett. He was on Talking Billions, and he tells those stories how Buffett would skip Ben Graham's class and go to an annual meeting that was across the river in New Jersey, and would go see the management and ask questions. So we might see Buffett today as sitting in a tower in Omaha and reading annual reports, but he spent a lot of time actually visiting companies. Yeah, and I'm sure you remember the story how he went to visit Geico on a weekend because he had some time off, and he ended up sitting down with the chairman, from what I remember. And so that kind of knowledge acquisition helps. I remember sitting in New York in an office in a high-rise, and we were researching a company, and I would say sometimes, would it be okay if I just left this afternoon and I'm going to go to the store and I'm going to hang out for an hour or two in their New York location? I just want to see what it's like, because we're researching this company that has, 5,000 stores in the country or whatever. And I said, well, there is a location. I know it's a flagship, but I just want to hang out in that flagship and see what it's like. What are people looking at? What's the pricing like? How are the salespeople even treating customers? How are the customers interacting with the brand? Is anything on sale? Just wanted to see it. And I felt like this was something that was not done often enough. And it gave me this additional flavor for the business. I think that's the best way to describe it. We're all looking at the same numbers. We're all looking at the same annual reports. Now AI is speeding it up. But I think going to a store and actually seeing it, which is more and more challenging because a lot of the businesses out there are kind of virtual. You can't really touch online search like physically, right? But you can interact with it and see how it works. You can ask people how it works for you. Is it helpful and is it serving your purposes? But interacting with the actual business, I don't think that's going to go away. Just if you have a chance to interact, just sign up for it, use it as a customer, ask a few questions, see how the help desk works. Just if you are going to put serious money behind it, a big portion of your portfolio, go the extra mile and interact with the business you're about to buy. And if it's total sense. It comes at a very limited cost, but just maybe I'm giving away a secret here.
Trade secret.
So your snow is Talking Billions, I'm a big fan of the other Billions on Showtime, and there's an episode where Axe is talking to a young analyst, and he says, "Here's something they don't teach you in business school. Every now and then, you want to take a company and put it in your mouth." And he's talking about Young Times, where he's shorting. It's a Twinkie manufacturer. They start eating these Twinkies, and they realize they don't taste like they used to when they were kids growing up eating them. And I thought it was always a good line, because so often we don't put companies in our mouths. We read, we get information. To experience it, it might just give you that incremental insight that makes all the difference.
It goes back to Peter Lynch. He told us to just look in when you're shopping around, what ends up in your basket. Like, that was his idea. Just look around in your life. And I want to highlight here, because just because you love something as a customer, as a client, doesn't make it immediately a good investment. I want to highlight that, because it's such a mental shortcut here. There are a lot of incredible businesses when you're a consumer, a customer, that you might not want to be a shareholder of those businesses. They might have not figured out the equation here, and maybe they're undercharging for whatever they're offering. And so it's a dangerous territory to just say, I'm using this, so I'm going to buy shares of it. No, I think there's a lot more. But if you have a chance to interact with a business, and Phil Fisher wrote books about it back in the day, interact with the business. And you've already done so much work on that stock. If you have a chance, just get a pair of their shoes, or if it's an online business, interact with it a little bit. Is it really what you think it is? And if it is, that's great.
Well, I can tell you, I'm not making up any investment recommendations, but I spend a lot of time at Costco, Netflix, and listen to Talking Billions on Spotify, man. You can't go wrong with those things, that kind of names. That primary diligence and watching what the kids. Yeah, I got another.
Tough insight.
Another 1% IRR question, but you go ahead, Jeff. There's something on that topic I wanted to give another right turn here. Okay, you're a prolific writer as well as podcaster. So the writing is one of the more challenging, I think, endeavors. Certainly that I talk about this to people that I never really wrote somebody. I would write for other ideas, like I had to write an essay for school, or then we get into the finance world, investment banking, you're writing like a deck or a pitch. It's for something else. But when you're writing when someone wants you to understand it, it's like the most challenging thing. I just never understood how challenging it could really be, and thinking of the right word. But you're a big writer. So walk us through a little bit of the process of writing. Now it's gotten so easy to hack it with AI, and it's a lot of times you can write 5 bullet points, give me an essay, and you're like, this is actually pretty good, but it doesn't really reflect you as a person. But give us a little secrets on the writing techniques, because I think a lot of people could use that.
So I have this idea that when I write something, I realize that I won't be in the room when somebody reads it. It's such a simple statement, but it's so profound to me. That in many cases as a student, I remember writing an essay and the teacher would get back with some feedback and I could kind of defend, like, oh no, you misread it, or I miswrote it. But when I write a piece, I realize I will not be in the room to answer any more questions until somebody writes to me and says, I disagree with it. And I realize I framed it the wrong way, or it's incomplete in some way. So before you think it's ready, ask yourself, are you okay with the fact that somebody will read it in a room and you're not there?
Very good.
That's very good.
And then, very often it doesn't happen in one single writing. I have pieces that I rewrote, and I have a count of versions 27 times. So I'm pretty diligent about rewriting something until it's exactly as close as possible to what I intended to be. I still have no control how people will interact with it. And it's not the goal, because you will see whatever I write or whatever I told you today through your own experience and for your own biases and framework and mindset and a mental model. So I have no control how whatever I say is going to land. But I wanted to leave the inbox in a way that is the closest to what I wanted to capture. And speaking of capture, I had a few conversations with friends that write, and I told them, when you corner, and there are those stories of, bestseller novelists that wrote, 50 novels. That's not me. But they asked them, where did the idea come from? And they always come up with a beautiful answer, I was on a walk or something, or reminded me of a childhood story. But then at the end of the day, they say, I have no idea where the idea came from. I just don't know. And I have this almost metaphysical visual here. Maybe it doesn't belong in this conversation, but I'll take a risk. And that ideas are actually floating almost in the air, whether it's an article, and they might have been a product of your acquired experience and intuition and everything else. But if you come across something, and I was walking in New York this summer, running between meetings, seeing clients, and I had this idea that popped in my head that became the value investing article that you guys referenced. And I had no pen, no pencil, no legal pad, as my colleague back in the day mentioned. And I just turned on my phone, put in my headphones, and in New York, people talk to themselves anyway. Before the Bluetooth headphones existed, people would walk around, talk to themselves, so it's nothing uncommon. So anyways, I walked a couple of blocks and I'm just talking to myself. It was a stream of consciousness of what I want to capture here, because it's a certain phenomenon that I'm seeing. So I talked to myself for, 10, 15 minutes until I got to the next place. And I just saved it and transcribed it and took notes. When an idea comes to you, just write it down and find a way to capture it in that moment, because I almost feel like if you don't catch it, somebody else will.
And it leaves quickly.
It just leaves, exactly, and it's just gone. So our mind works in a peculiar way, and the more I read about it, the more I'm fascinated with it. We feel like there's this, I'm so conscious of what I'm thinking, I'm so conscious of why I bought this stock, but our mind is at work even when we're not thinking about things. So I read a piece last night, and I'm thinking about it, and I'm walking, and something just connects in my head. So I know that my brain was working when I'm not even thinking about it, and it connects two things that I read last night. And I write it down right away because it adds a bit of value. You know, the 1% you talks about, it adds a tiny bit of value to a stock I'm holding. Like, I haven't thought about it. Let me look it up when I get home. Just write it down that minute, because it's all those little things add a huge value. And it's a decision between I sold it or I held it the extra 5 years. Sometimes it's that kind of a decision. So if you can capture those little moments that are very subtle, very human, and very relatable to all of us, I think across your performance, if it's music for you, or you're writing poems, or you're investing, for me, it's, a form of expression. Capture those moments and have a system to go back and use it in some way.
Bogumil, this reminds me, when we first met, the first night that we had a conversation, I think was at Value X Cloisters at dinner. And we were talking about this, about how the mind keeps working. And I think I told you about, like, with music, like for me, I play guitar and I might be learning a new song and I'll be playing it like shit, right? And then I'll just put the guitar down for a day and a half and I'll just do something completely else. And then I'll go pick it up and I can play it, maybe not perfectly, but a hell of a lot better than when I was struggling with it a day and a half ago. And I think I found that to be true with so many things, right? Even if it's like reading about a company, I'm like, wait, how does this work again? And you're sitting there in a room trying to force it. And it's just like, I don't know. If I put it down and go out, ride my horse, go walk, hike, whatever, that's when everything clicks. And I've found as I've gotten older, if I try to force anything, 9 times out of 10, it's not going to go the way I want. But if I just, let go and let the brain kind of do its thing, it's amazing how it will sort it out and put everything in its place without actually trying to physically do it, right? And I think that's something I had to learn over time, because early in my life was always trying to force stuff, right? But sometimes letting go is
I
how
have
you
a
get to where you
quote
want to
from
be.
David Allen that I keep up on my little wall of things here. It says, your mind is for having ideas, not keeping them. And I have to constantly remind myself of that concept, that, you gotta put it down somewhere. And then that gray book back there is the Rick Rubin book, which is
that's a great book.
Not to give any reading, but it's a phenomenal book about ideas and the concept of them. But I have one nerd out question that I want to just double click on here. Is, you said 27? Is that like redlining, or are you like, I'm going to rewrite this from fresh and then compare and contrast? Like, are you like, or is it just like the next version of it?
They differ. See, the last 10 probably are more alike, but the first few, sometimes it's a total rewrite, because I see the idea. It's hard to explain. Like, sometimes I think, well, let me rewind a little bit. Language is a new concept for us as a civilization. I think an organized language, the way we use it, it's very recent, and some sort of form of speaking is 50,000 years old or so. Words do not capture, and I think you might have moments where, I don't know if you guys journal. I think journaling is very helpful, but if you try to capture with words your day, I always know, this doesn't give full credit to my day. It just doesn't. You might have had an incredible dinner with your spouse, and I don't know, the light was perfect, the food was great, the topic was fun, and the waiter was very nice, and they let us, I don't know, sit at a table we didn't think we were going to get. I don't know, there's so many. So I can explain it with words, but you guys will never know how I felt at that dinner. It's impossible, right? So I think there are those moments where ideas just come to us, and we're trying to use words to share them with our future selves and with somebody else, because a lot of writing that I do is actually for my own benefit. And I would say it's almost like an iceberg, just a portion of it gets visible. It's made visible to the world, but it's my own personal writing, my own reflections, but it's also writing about the stocks I'm interested in or I have. I just continuously write. And sometimes it's not a beautifully edited text. It's just thoughts that I have or something that I noticed that I want to write down. And then the end product, it's an essay on Substack, but that's like, it's been through a lot before it's there and shared. And so it's a process, but I think writing is a practice, and trying to organize your thoughts is a practice. And I think I met enough investors that maybe don't publish, but they definitely write. There's no way that I can't imagine being an investor without writing things down, even if nobody sees it. But you have to keep on writing things down, because hoping that you're going to remember everything you've read in the last 5 years about a stock you want to hold for the next 5 years, there's not a chance that you're going to remember it. So you have to have a way to go back and reference something and bring it back to your attention. Having that kind of a system of capturing the idea. And if you're going to share it with the world, give it some time. And I mean, there are tools that do spell check and so on. You said AI. I think AI can help and give you feedback. I think there are some tools where, you can ask, how would you make it better? But I think people can tell, I can tell right away that this article was written by AI from the beginning to the end, especially if I know the author. And it's a tricky place to be. I know there are huge demands on us to write more and produce more. I've actually toned down. I was writing every week during the pandemic. I write every 2-3 weeks now. I definitely have more things I want to write, but I honestly don't think I have the time to produce them at the level I expect of myself on a weekly basis. I just cannot. So I decided to do it every 3 weeks, but write something that really is on my mind and I really want the world to hear it, and then challenge me back and tell me where I'm wrong. I love that when people say, you got this wrong, because that's when I learn, not just by everybody telling me you're absolutely right, but tell me what else I'm missing.
Well, you're kind of
thinking out loud, man, is important. Yeah, exactly. It's hard to get to, and but I do think it does make you better.
Well, look, hey, we got about an hour and 17 in here, guys. Maybe final thoughts. I know this is meandered. Which I love, all the different places we've gone. But Bogumil, one of your articles, I love the analogy you gave, was, talking about you were on a road trip and you were, I don't know what kind of car you were driving. Was imagined a minivan or something, right? Like not very fast, sports car that had passed you several times. Yeah, apparently you were going in the same place or similar direction. And then you realized towards the end of the trip that you were pulling out of a gas station, or you were going past a gas station, and the sports car that had passed you a while back was pulling out. And despite being faster, being more maneuverable and all that, and having passed you, because of all the nuance of whatever that person was doing, you ended up at the destination at the same time. Yes. You not in this fast car, this guy in this fast car. And you kind of, you use it as I guess, an allegory for, investing approaches, right? Yeah. Wealth creation, counting wealth, there are multiple ways to get to where you want to be. And, but understanding the nature of the journey kind of vis-a-vis, your mindset, your investor's mindset is important. So some of us, if we're trying to build wealth, might want to take a more aggressive approach. We're trying to conserve wealth. We're trying to, take a more, conservative approach. And I really like the article, but one of the things that got me thinking about was something I've been doing more of is I try to think about if I'm making an investment decision, be it in an individual company or strategy or whatever it might be, I try to think about if it doesn't go the way I think, how is that going to emotionally make me feel and affect my ability to make decisions after the fact, right? So if I go super deep on a company and I make it 20% of my portfolio, if it doesn't work out, I know that's going to be emotionally difficult for me to swallow. And it might make me not see opportunities that I would otherwise see at that future point in time because I'm wallowing in all my self-pity or whatever. And so I've read interviews with traders who say, when they, like prop traders, at the beginning of the year, they trade much more conservatively, even if a big opportunity comes along, because they know if it doesn't work out and they're in February or March and they are maybe halfway into their risk limit, that they will trade so differently in that period that they don't want to take the same risks at the beginning of the year because they're afraid of how it might affect them later in the year. They want to take risks in the middle of the year when they've already built up a big P&L cushion. And if you think about it logically, if a great opportunity comes along in January, you should take it if you're a prop trader in the same way you would take it in June, but they don't because they think about how it will affect their future selves. And I love that. And so your article kind of rhymed in a way with that. What are your thoughts on that? I mean, because we oftentimes don't think about like, look, if I do this investment and maybe it works out. Let's say I do this and my net worth doubles. How is that going to make me act in the future? Am I going to be more cocky? Am I going to take maybe risks I shouldn't? And so I've been trying to incorporate this into my thought process. What are your thoughts on that? On trying to evaluate how a decision, if it goes positively or negatively, might affect our future states and how those future states might affect our ability to make wise decisions from that point on a forward basis.
I think it's such an important point, and it applies across the board, and I'll explain why. You know, when I was learning about business and finance at university, there are moments where it feels so abstract that it's this imaginary money that you're investing in imaginary stocks. You're this imaginary perfect human that has no emotion, and you're aiming for this imaginary goal of a certain return with a certain volatility. End of story. You have the perfect portfolio. And then you leave school and you sit down across an actual human being, your client, or somebody else's client if they let you sit on a meeting. And you realize, wow, you know, it's a lifetime of savings, or if it's an inheritance, a money that they can't afford to lose, but they want to deploy it. They feel a sense of urgency that this money has to be invested in some way so it serves the next generation or themselves. You have a real human being, and our decisions are made within a context of somebody else's emotions and our own emotions, right? And obviously the stock that works out gives you a lot of confidence. I used to, when I was giving talks, I would ask people, did you make money or did you lose money on the very first stock you ever bought? Like, for a second, think about it. And the whole room would get quiet. And some people would start nodding and they say, I lost money on the first stock. And I thought this is going to be a very different conversation than having a room full of people that made money on their first stock, because you feel like this stuff is easy, you know? And I think it sends a whole wrong. I lost money on my first stock and I'll never forget it. And it wasn't a lot. It wasn't meaningful. But it taught me something, that you might do all the research, all the work, but you're interacting with an ever-changing world, and the future value creation might be, or loss might be, very different than what you expected. The point in the article was that a lot of us are focusing on the return, maybe sometimes volatility, maybe sometimes a drawdown, but we're not talking about the actual journey. You know, people show me a 10-year return. I manage separately managed accounts where I have a lot of flexibility. Clients have different needs, so I can do a lot more for them, and they have different tax situations and on and on. But anyways, when somebody shows me a 10-year record and it says this much, it tells me really nothing, because somebody might have gotten to that point with 80% drawdowns. And I know folks that are living for 75% drawdowns in the last year or two, and they say they're fine. I mean, more power to you. I know a lot of people that wouldn't be fine with that kind of a drawdown, especially in an up year for the market. But anyways, it's a very painful experience with your clients. If you're managing your own money, it's a whole different conversation. If you're okay with it and you have the stomach for it, more power to you. It's not me. But if you're managing other people's money and you want to take them on a journey, and they sign up for it, that will take you through massive drawdowns and massive pain, especially when their neighbor is celebrating buying a new car. It becomes difficult. So I think we have to add this whole layer to the conversation where what kind of a journey you're signing up for. And this idea came to me because on that weekend drive, you know, I couldn't really drive fast and I wanted everybody to be comfortable in the car. So we paced ourselves, and the sports car at the end of that day met up with us again. We don't know who it was, but I paid attention. And I thought, whoever was in that car, they must have been driving super fast, stopping. Maybe they spilled coffee all over their lap. I don't know, but it took a lot for them to get ahead so much. But then at the end of the day, we were in the same place at the same time. I was taking this idea to its, logical limits, but I thought it applies in investing. When you say, I had $1 million, I have $2 million today, it tells me a little bit. If you tell me that you did it over 5 years, it tells me a little bit more. But if You show me what it meant for you to get there. Forget even outperformance and is it this index or that index, but how did you actually get there, and can add a lot more. And depending on who is in your car, and think of your clients as people that are joining you on this drive, you have hands on the wheel. You are responsible for them throwing up in a bag back there, or actually having a enjoyable conversation and finishing their coffee in the car. Very different experiences, and we don't talk about it enough. We say, this kind of return, or he tripled the money in this many years. It doesn't really tell you the whole story. An emotional impact that our investments have on us is huge. I know a lot of experienced investors that had a really hard time in March 2020. I know people that had a lot more experience than I do. They called me, I talked to them, and they told me, I can't stand the pain. I don't want to go through another 08, 09. I'm selling everything. And they told me that when the market was at the bottom, and they moved on, they're doing other things. But I saw how we all have our limits. Maybe the three of us were buying stocks, but there were people that hit their limits, emotional limits, in March of 2020. And they said, this is not for me. This is too painful. So we all have to find our comfort zone and whatever works. I think investing is a beautiful gift. It doesn't mean that you have to find your own way to participate. I think that's the biggest lesson, right? You have to find a way that you can benefit from this incredible invention that the stock market is, the ability to buy a collection of businesses. Forget the index, forget the outperformance. If you do outperform, that's great, but how can you participate in it over a long period of time without losing your sleep, losing your mind, and throwing up in the back of the car? That's a better question to ask. And I think a lot of people go in and they say, they have exorbitant expectations in terms of how much money they're going to make and how quickly, and they are in for some surprises. And the handful of us that stick around over a long period of time, you realize that we have a lot in common. We found our own way to play again and again this kind of an infinite game of compounding wealth. This is the goal here, at least for me. And I'm not going to be the fastest car on the road, and I'm not going to have the best performance in all the years, but that's not really the goal. The goal is, how can we stick around long enough for this process to actually matter? Compounding pays off the most in the later years of the process. I'm sure you guys have heard the story how Buffett made 99% of his money after the official retirement age of whatever, 65. It's such a staggering statistic when you think about it. He's been very wealthy and very successful when he was 45 and 50, right? And here, he had not made 99% of what he has today until his 60s. And he has one of the best long-term records that I can think of, right? Like, how humbling that is. But to flip it on its head, when I go to Omaha, I'm looking around, I'm thinking, yes, there are two billionaires, well, now two billionaires sitting there and talking to us. But anybody that's in the room that participated in investing over a long period of time and has even a fraction of what they have, they're in a very comfortable place already. You don't have to be a billionaire. I have Talking Billions in the name of the show, but even if you get to whatever number works for you, it's enough. Like, we don't all have to be billionaires. I wish everybody was a billionaire, but I think to reframe the goal here.
It wouldn't be cool though, right?
It would be cool, yeah.
By the way, Bogumil, I was going to tell you that when I read your article, the first thing that came to mind, I'm a big fan of National Lampoon's Vacation.
Yes.
And they're going across country, and there's a sports car in that one too, driven by Christy Brinkley, always catching up. So when I read your article, that is the first thing that came to mind. So yeah. Well, look.
Well, a great answer. That was great.
So
I liked it.
Any final thoughts? Otherwise, I think we probably should wrap up. Donnie?
This has been a treat of a conversation, and you have a wealth of knowledge. You're a philosopher investor. I think I would put philosopher first. So keep it up. And
I would put philosopher
great to follow
first
along.
too. And I know you didn't get to come to Value Seaville last year, but this May, if you can make it, Bogumil, we'd love to have you back.
It would be great.
Because
I came the year before last, 2 years ago. Yeah, it was really great. I love the space. I don't know if you still hold it at that old.
No, we moved it to Boar's Head. It's even better. We have it at Boar's Head. It's 2 days. We incorporate golf and tennis, and
Amazing.
So we do the Jeffersonian dinner still, and then we do. I think this year we went to a brewery on the second night, so did 2 dinners. Nice. So it was a lot of fun. But well, thank you, Bogumil, for coming on. Thank you, everybody, for listening to the podcast. I think when you get to meet somebody in your life like Bogumil that has philosophical insights, my advice would be to make sure you remain friends with them, because you get these nuggets of wisdom that, but you were born in 80, right? So
Yes.
you're what, 45, you're 2 years younger than me. I mean, I have not met many people, that were 45 that have your years of wisdom, man. So,
That's very kind of you to say.
when you're 85, my God, what's going to be coming out of you then? I mean,
It's gonna be the
it's going to be
compounding.
insane.
Yeah, that's
It's a compounding of wisdom.
the other side
But
of
I think the
compounding, man, is
reason
the
you're that
learning
way,
compounding. Yeah.
Yes.
yeah, well, the reason I think you're that way is because you live the philosophy that you speak about, right? About
Yes.
thinking, talking to people, compounding, getting a little bit smarter every day. And, it shows, in my view, wisdom that is well beyond your years. And you didn't get there by accident, right? You got there because you have a rigorous approach to talking to people, to thinking, to writing. And I think it's great.
I'll share the quick anecdote to close it off. But I was at the airport in Omaha, leaving after the Berkshire meeting, and somebody walked up to me. People walk up to me now and then and say hello. And he walked up to me and he was nervous and he started asking some questions. We were talking. And then at the end, he says, "You're exactly the way I pictured you after reading and listening to you and watching some of the episodes." And I said, "Well, what did you expect? I feel like life is a lot easier if you are exactly who you are all the time. I don't really have the brain power to be somebody on this podcast and somebody with my wife, right? Like, I think if you find who you really are, and it's a journey. I think I'm still discovering more about myself, and the questions you guys ask about, the early days, I think make me question some things and make me see things in a different way. But if you figure out and get closer to what you're all about and why you're on this planet, I think life becomes a lot lighter and easier. And I think we spend too much time trying to be somebody else, maybe to impress someone, or I don't know, have a job you shouldn't have, and on and on. But if you figure out what it is that you really, really want to do with this time on this planet, everything becomes a lot simpler. And you realize, and it's a whole topic I want to write about at some point, it's really not about the money, which is a fascinating revelation to have after talking to 200 people about money and investing and ending so many conversations, walking away thinking, it's not about the money. I've met a lot of people that love what they do, and that the paycheck is something they don't think about at all. You want to own businesses that have founders that operate that way? They'll show up the next day because they care about the product, the service, the happy customer, and they don't even remember when the stock compensation vests, or they might have no stock-based compensation whatsoever, but they own a chunk of the business. And then you figure out and realize that clients are looking for an advisor that's showing up and doing the right thing, even if they cannot maximize their next invoice. I think that's what you're looking for. You're looking for somebody that's going to do the right thing, even if nobody's watching, and even if nobody can really evaluate if you did the right thing. But deep in your heart, you're doing the right thing. I think that's a very beautiful place to be, both on the investing side and turning it around and providing a service to people that need your help.
Sorry. I think that's great. And I couldn't agree more. And I would add too that I think a big trait there is empathy. Right? I think good business people can empathize with people, know what they want, and that's something I think that I think people are born with. I think that's hard to teach. I think it's something that people have or they don't. Anyway, man, that's a whole other podcast we can go into.
We'll do part two.
For coming on. We hope to
Yeah.
see you next year at Value Seville. For all the listeners, guys, thanks for tuning in. We're going to keep them coming. We're going to keep coming with interesting guests like Bogumil. Sometimes we're going to be talking stocks. Other times we're going to be talking life philosophy. I mean, the thing I love about our podcast, Donnie, is we kind of let it go where it goes. And I think it's great.
Amazing.
So thank you, guys. And we'll see everybody next time. Take care, guys.
All right. Take care.
All right.